The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, live to tape, I guess I could just say, from sunny Savannah, Georgia, here at the OIC 2011 conference. And we're going to mix things up a little bit because we're down here at the conference where Don is safely ensconced in his home up in, he's upstate New York, right? Yeah, so he's off in sunny upstate New York right now. But I am actually joined in this episode by Robert Krause. He is the founder and CEO of the Volatility Exchange. Rob, welcome to the show.
Thank you, Mark. The first time I was on the program, well, it wasn't on this program per se.
On the Options Insider radio show at FIA. Yeah.
Yes, that was at the FIA show back in, October of 2010. And we gave a quick overview of the product. And at that time, we were planning to roll out vol contracts, early next year, which would be this year. And since then, a lot has happened. As you know, we started the Volatility Views program, and we launched our first contract. So a lot of very exciting stuff.
We can take advantage of the fact that we have you on here to do a nice little overview of the vol contracts, how they work, and the mechanics of them. But before we do that, we're going to start it all off with our Volatility Review segment.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, where we look back on some of the activity from the previous week across the broad spectrum of volatility products. And because we are recording this midweek, we'll have a bit of a midweek overview. And so, Bob, obviously, we have you on the show today, so it's a good opportunity to discuss an overview of what's been going on in the vol contracts. I know Don and I discussed last week that there's been some significant movement. It's been quite the roller coaster in Eurovol over the past few weeks. So is that roller coaster continuing? What have we been seeing in recent sessions out in the Eurovol contract?
Well, in just the past few days, it's hard to quantify this. I would say it calmed down, but it calmed down at a high level. So that's it's very strange when you're talking about volatility and the underlying. So Euro FX has been moving around. It's been fairly volatile. It continues to be volatile. As you know, last week, Thursday, Friday, we had some very big moves in the euro. That caused the vol contract to actually explode in the last few days just before expiration. I believe that just before expiration, let's say last Wednesday or so, that we were trading in the 9.5 to 10 area. And by expiration, which was just that Friday, then we jumped and settled at 1277. So it was almost a 25-30% gain in a couple of days.
Yeah, like I said to Don, that was a roller coaster ride out in the Eurovol.
Right, and since then we've hung around the 12.5 range. So in some ways, it's been stable. The volatility's been stable, which means that the underlying euro FX has been fairly volatile.
So yeah, stable at a high level. I guess that's a good way to put it. I know it's surprising to me. We've had this discussion with Don on previous episodes as well. Is that despite all this vacillation and movement in the underlying, apparently there still is some reticence around realized vol because they're afraid it won't move in response to the activity of a few data points. And I think the past few weeks and the past few sessions, I think, would be a strong counterpoint to that argument, to that question.
Oh, absolutely. And I think this really offers a great segue into how the product works. So if I can explain, exactly how it works, either, to give viewers a review from last October when I first did that, or since if you may be new to the Volatility Views show, to kind of review the mechanics, and then explain how it could change so much even in the last few days, because it seems like if your initial thought is that the volatility is going to be converging as we move through the realized volatility period, because more and more of the data is known. So it seems like,
reasonable assumption.
Yeah, it seems like on the last day or last couple of days, why even trade it? Because you sort of know where you think it's going to settle, or within a few points or whatever.
20 of 25 data points or so you know the bulk of what's been going on.
Right. So that's the assumption, but in fact, that's far from the truth. So let me explain how the product works to give everybody a good understanding of that, and then we'll explain how it could actually move so much even on the last day. So what we do is take the realized volatility over 2 time frames, either 1 month or 3 months, and both of those contracts are trading right now. And if you look at the formula, some people that aren't good with formulas and calculations and stuff like that, their eyes may glaze over and say, wow, that's too complicated. But if you look at it and break it down into 3 different parts, it's actually very simple. The first part is multiplying by 100, and that just gets rid of the percentage sign. We talk about volatility as 10% or 20% or whatever, and we're just converting it to a whole number of 10 or 20 or something like that. So that one's simple. The next part of the equation is 252 over n, and that's just an annualization factor. When you talk about interest rate products, T-bills, a 1-month T-bill, and you say 1-month T-bill is 1%. Well, you don't get 1% for 1 month. You get 1% for a year, and you get about 1/12 of that for the month. So just like interest rate products, vol products are always annualized, and that's just an annualization factor. So if you go to the third part of the equation, all it is R squared, and R is the return. So what we're doing is taking the daily return each day. So it was up 1% today, it was down 2% the next day, it was up 0.5% the day after, and we take those returns every day for a month and essentially average them together. Right? But we're not averaging the returns, we're averaging the square of the returns. Okay, so we square those returns, and that's at the essence or the heart of the standard deviation formula that basically produces the bell-shaped curve and the normal distribution that everybody was graded on in school.
Yeah, we discussed some of that, obviously origins, and obviously, especially on our show about OTC variance swaps and vol swaps, we got into a lot of the roots and the benefits of having the squared volatility versus the square root volatility versus the squared variance, with the strike prices get a little bit unwieldy, I guess is probably the best way to describe them.
Absolutely. So now, what do we do with that formula? Well, every day that goes by, we know a little bit more of where this contract is going to settle. For instance, if we wanted to trade, let's say the underlying is gold futures, and we take the settlement price every day for the month of May, okay, and by May 30th, then we have all the information we need. We plug it into this formula, and it tells you the volatility for the month of May. On May 30th, then, we would expire the contract to that calculated value. On May 1st, though, wouldn't be the start of the contract. We could trade long before that. So let's say January we list. January, February, March, April, we'll be trying to forecast where May volatility will be.
I think that's where a lot of, the listeners get a little confused, obviously, is how do you do realized vol ahead of when the period is? And obviously it is just, like I said, based around preliminary forecasts. Obviously there are no data points yet, so you can't it doesn't really fall into the realized camp yet until it's actually started to be realized. So it's based off forecasts.
Absolutely. So it's just a pure forecast until, in our example, until we get to May 1st. And then when we're in the month of May, the game changes a little bit and we start calculating the actual volatility of, say, gold or euros or whatever underlying for the month of May. We can do that over 1 month or 3 month period, and we do that because 3 1 months are not the equivalent of 1 3 months, and that has to do with the standard deviation calculation and the fact that volatility is really a curve function. And essentially, think of it this way: you can't have 3 monthly curves, added or averaged together and make one big long curve. It just doesn't work that way. So the 3 month volatility, realized volatility contract is different than the 1 or the 3 1 month contracts. So having said all that, so that's basically how the product works. It is actually very, very simple, but what are some of the things that you notice? We're only basing it on settlement prices, the returns per day, the daily returns. So the open, the high, the low, none of the trades in the day matter. It's just where does it close or where does it settle. Now, in some ways you might say, well, you're not capturing all the trades within the day. You're not
the intraday spectrum.
Right, the intraday volatility. And that's true. You're not capturing the intraday volatility, but what's interesting is that you're just losing sort of a degree of precision, not necessarily losing the volatility.
I'd imagine that would add orders of magnitude to the complexity of the actual calculation and generation of the instrument for a marginal gain in accuracy.
That's exactly correct. The marginal gain in accuracy is really not worth the hassle and the problems and then the confusion that would lead by calculating it that way. You would also need to adjust. For instance, if we were to roll it out on euro currency, that market's virtually 24 hours. But what if you somehow listed the product in broiler chickens? Okay, it's only traded 4 hours a day. Well, a 4-hour contract or a contract that's only trading 4 hours a day is going to have much less of a range than a contract that's going to trade 24 hours a day. Take it to its extreme. The butter product that trades at the CME.
Very deep into the commodities and ags.
Right, and they trade 5 minutes on Friday. Okay, so you can imagine that the range is not going to be very big.
Not too many data points for that one.
Right. So you're going to need then a very sophisticated kind of adjustment factor.
Are we seeing a strong demand for a realized vol butter contract? Is that the next product coming from VolX?
That might be number 2. So that's basically how the product works. Now we have settled on a $1,000 multiplier. So, for instance, euro volatility is hanging around 10. Now it's about 12 or so, but let's say just 10, then you would multiply that by 1,000, so it would be a $10,000 contract. And
that's pretty much in keeping with most of the futures multipliers we're seeing out there. And I think a lot of listeners come to this thinking of equity options and equity options multipliers of the traditional 100, but these are futures products, and so the multiplier is a little bit more commensurate with the size of those contracts, I think, than what the equity guy is typically used to.
Right. Now, what you'll see, though, is most financial products have low volatility. Generally, for instance, currencies are in the 10% range. Bonds, euro dollars are very low, depending on how you measure them. And the S&P is, in the 15 to 20% range. But when you get into agricultural commodities, you'll often see, crude oil varying at 30, 40, sometimes 50%. Okay? So now, what we plan to do is then offer a lower size contract for the commodities.
Okay.
partly to adjust for the fact that commodities are more volatile themselves and the fact that more or fewer institutional players play in the commodities per se as they would in the financials. At least the proportion is less. So what we want to do is get the contract size roughly the same, in fact maybe a little bit lower than the financial products. So in financials, in euros, in S&P, in currencies, we can support 1,000 multiplier because then you're multiplying it by a low volatility value of, say, 10 or 15 or 20 maybe. And then for the commodities, we would probably multiply it by 100 because it's already, a high number.
Vol, yeah.
So 30, 40, and 50% vol will be a $3,000, $4,000, or $5,000 contract.
Yeah, that gets into the same problem the variance swaps have, where the margin requirements get a little preposterous if you start using the large multipliers on some of those high vol contracts.
Absolutely, and that's why our patent even doesn't cover variance. I thought that there would be no market for that in the futures world, partly because it would only appeal to a very small group of players, and that would be the largest of institutions. And those guys don't need a listed product to express a variance view. They can trade among themselves in the swap market and get that exposure. But if you don't attract a whole host of users from hedge funds and option players and retail and speculators, day traders, and all of those, then you really don't have a vibrant market.
Yeah, you can't exist solely on. Well, you can, but it does require solely institutional. It does require a little bit more of an ecosystem around it to make
right.
a vibrant contract. All right, I think that's good for the volatility review segment. So with that, we're going to roll right into our crystal ball segment.
And now we take a look at the crystal ball.
Welcome to the Crystal Ball segment. This is where Bob speculates wildly, and I have to restrain him from breaking the bounds of compliance. But this is where we talk about what we might see in the coming sessions and some of the different volatility products, including the Euro Vol. And obviously, we discussed that it has been quite the roller coaster in Euro Vol and the Vol contracts. Recently, it's somewhat plateaued. Are we expecting to stay in this range, you think, or you think we're going to have another roller coaster week ahead of us?
Just judging by the news, I'm certainly no expert in Euro FX trading, but judging by the news, it sounds like we're going to stay high for a while with all of the events going on around the world. But it's interesting to look at the volatility cones. I know that you mentioned that on previous shows. And
it's been giving your webmaster quite a bit to do recently from all of our listener feedback.
That's right. And we actually just met with a market maker yesterday, and I mentioned that we have volatility cones. He was practically jumping out of his skin that this was available. He says that that's one of the most useful tools he's ever seen as far as volatility. What's interesting about those cones is it tells you the percentiles. It essentially says, at let's say 12%, volatility is higher than that, 30% of the time, and lower than that 70% of the time, or whatever. So you look at the cone, you look for the approximate time frame that you're investing or requiring volatility or to hedge with or use, and the cone will tell you the relative probability of putting on that trade. And granted, all things being equal, right? But when you're, let's say, a managed futures trader or a hedge fund, you often look at your win-loss ratio. If I win 55% of the time, I'm probably a pretty good trader. Now, I have to caveat that a little bit because it depends on how much you win when you win versus how much you lose when you lose. But let's suppose you were playing, a one-for-one game, so to speak, either a flip of a coin or whatever. Then what you're trying to do is maximize your numbers of wins, okay? And winning 55% of the time would be great.
Be enormous, yeah.
Yeah. But, and probably some of the best traders trading, a one-on-one, one-to-one result would be winning at 60%. But with the volatility cone, you can pretty much define whatever percentage that you want. You could say, look, I'm only going to trade when I have a 70% probability of winning, or even 80%. But as you get farther away, getting closer to 80% or 90%, your number of trades is going to be fewer and fewer.
I haven't had a chance to pull it up. Where are we sitting on the volatility cone right now in for the Eurovol? I imagine we're at the upper end of that bound.
Yeah, we're very high. We're above 70%. I think we're approaching 90.
Wow.
So
you hear that, premium sellers in the Eurovol? There we go. Time to dive in.
And so right. So if you just play the odds, if you don't listen to the news or have an opinion on where it's going, selling volatility in the 12 and a half range, which is where we are about now, would probably yield a winning result by selling. Of course, that comes with a caveat that there's still a probability that you could lose, and when you have the 1 out of 10 chance that you do lose, you go, oh, that probability stuff doesn't work because I lost.
We don't do caveats on this show. We just throw it to the wind and let the dice fly high here. But Bob, I would be remiss if I had you on the show and I didn't ask you. I know we discussed this with Don a little bit last week, but we still get, the show has been tremendously popular, we still get quite a bit of email and questions regarding what's next for VolX. Obviously, a lot of our listeners are intrigued by the concept, but they're not currency traders, or they're looking maybe for a commodity product, or they're looking for some sort of equity option comparable product type of thing, or an equity vol contract. So what's next on the near-term horizon for VolX in terms of products?
Well, the only thing I can really tell you is that we're going.
There's no one listening. It's just me and you to be talking between friends. So you can just
so I can disclose anything, right? Yeah, right. We are looking for a blockbuster product. We rolled out the euro currency, and it's starting slowly. It's gathering momentum, but it's starting slowly. And in fact, if you look back at the VIX or even the euro dollar contract or euro currency contract, they all started very slowly. So, it might take years to develop the product and develop the liquidity and the volume that people need to actually get executed at a good price. But the point is that we would like to roll out on something really big next, so that we can prove that the product works. Right now, with euro vol contracts, it's hard to tell whether, is the product flawed, or is it just building, or what is it? So we get lots of encouraging calls and feedback that I'd love to trade the euro, but it's not liquid enough yet. We've got, I literally could go through my Rolodex and probably pull out, 2 or 3 dozen guys who have said that they're willing to play. They just don't want to be first on the dance floor.
Isn't that always the case?
Yeah. So it's a hard thing to build liquidity. So what we want to do is start with our next product that gives it the best chance of success. Then we can prove that, yes, vol contracts work. They provide a definite need for hedgers and speculators, and the product goes through its cycles, and the margin is reasonable, and the contract size works, and all of those things. We just need to prove that. Then we can roll it out on whatever. You pick an asset, and then we would like to do that. So we would literally like to roll this out on assets around the world, futures, stocks, ETFs, make it the standard way to trade realized volatility on a host of assets. And having said that, what we need to do as a company is prove that the concept works. And so we need to come out with something big. Now, what is big? Well, you can pretty much just look through the volume figures at any of the futures exchanges and determine what's big. The S&P is big, Euro stocks in Europe, Euribor and Eurodollars, T-notes, the JGB in Japan. Those are, or even the Kospi in Korea. That's a huge product. So anything with lots of volume is on the table right now, and we're in talks with various institutions. We're trying to get committed order flow. We have...
Everyone who comes on this show this week is going to say the same thing. They're trying to get committed order flow for their products and for their exchanges and what have you. It's the ongoing quest.
Well, yes and no. I would venture to say that many of the exchanges, because we're now electronic, they can throw up an instrument and
the nominal cost is nothing.
And the nominal cost, the cost is practically zero to do that. Before there was an electronic, venue, they had to physically allocate space. You had when you came up with a new idea, you had to figure out where you were going to put the pit. And then, install the phone lines and everything. And you get commitments from people to say, yes, it's worth it. I want to be there, set it up, go through the expense. Now with an electronic venue, they could just throw up something. And recently I heard ICE had something like 8 new crude oil products.
Yeah, they throw them out there quite a bit.
And so even the CME, we talked to them, and they launched something like 10 new products a month. Well, they're throwing them up, but they're not doing all of the work needed to support that. Get the market makers and the order flow providers and advertise and all of those things that needs to be done. That's what we're committed to. That's what we're doing. We're attending all the shows. We're advertising. We're doing seminars and webinars and the Volatility Views show.
A little radio show some people may have heard of.
We're trying to get everybody aware of the product, make sure that they understand. But what's nice about it is as soon as you understand how vol contracts work, it doesn't matter whether we're trading euro currency or S&P or Euribor or pork bellies. The formula is the same. Maybe the multiplier is different, but that's about it. As soon as you understand it, and now it's just another asset.
Well, yeah, that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views. I want to thank our special guest here, Bob Krause from the Volatility Exchange, for coming on and filling in for Don very admirably, I must say. And before we go, I know we always do a little bit of a plug of what's coming up on the old VolX.us website. We obviously have had the volatility cones going and various tweaks to those. Is there anything else up on the website that you want to make our listeners aware of?
Yeah, the last thing I would like to talk about is the volatility indices. And we have these indices on really just about every major asset, all listed on the website, all updated every day. And so even if there isn't a vol contract traded, you can still go there and find cones or indices on the assets that you may be interested in, whether you're trading options or just using it for risk control purposes or whatever. It's all free. You don't even need to register. You just click through and you're in. The volatility indices are very interesting in that we had to create, needed to create 9 indices for each asset. And how that works is we wanted to give you a historical view of say 1 month, 3 months, and 12-month look-back periods. So what we do is we use the vol formula, the return every day, but we measure it for a month. And then tomorrow we have new data and we measure it for a month. It's actually 21 days. So we have a rolling 21-day calculation, and then that gets plotted. We use a 63-day calculation, and that gets plotted. That's roughly 3 months. And then we use 252-day calculation, and that's a 1-year volatility. And that'll give you a longer-term view, a medium-term view, a short-term view on volatility. And that's just the historical volatility. So there are 3 of those. But when we roll out vol contracts, then you have then you're trading this thing called volatility. You need to know how risky that is. And you need to know that for margin purposes. You need to know it for risk control purposes. So if you're trading volatility, you need to know how volatile it is, and that's the volatility of volatility. And we have those in 1 month, 3 month, and 12-month historical look-back periods as well. And finally, our crack IT expert, Norm. Norm is
been very busy lately.
He's been very busy, and he's just incredible, and he's getting all of this stuff up and very easy to use. And please, if our listeners have any suggestions, please let us know. We're working with Robert Engel and the Volatility Institute, and they are supplying us with these GARCH-based forecast volatility. So we're using the same time frames, but now instead of a historical look-back period, we're looking forward. So we're using GARCH to forecast 1 month, 3 months, and 12 months out. And so that, if you add up the 3 historical volatilities, 3 vol of vols, and 3 forecast vols, that's 9 indices on each asset. And that should give users a very good perspective on where vol is going, where vol has been, what is the range, all of those kinds of things.
Something to do while they're on the old website. I think our listeners are constantly surprised when they go there that it's not just data for vol contract traders. There's actually is general utility, interesting things. The study you guys did on vol cones years ago, yourself and Don is on there. Obviously the vol cones tool, the indices we just discussed. There's a lot there on VolX.us, even if you're not a currency trader or not trading the vol contracts. You just wanted to dig a little deeper into the old world of volatility. And of course, if you'd like to learn more about that, you can visit VolX.us. And if you'd like to post a question or a comment or leave any feedback for the guys running the VolX website, you can always post a question in our forum at theoptionsinsider.com/forum, and then scroll on down to the Volatility Views section where you can post your questions and comments. We've had a lot of great feedback there already. Don's been very busy posting away. He's actually been carrying the ball for me. I haven't had a chance to get in there and respond recently. So Don, as soon as they go up, Don dives in. Don even said he's been fielding some phone calls lately. So he's been quite the listener interaction man. He's really carrying the flag on that front.
Well, that all goes to our commitment for education and training, and we really want to educate people about volatility, about risk control, and trying to provide them with the tools they need, regardless of whether that means they're trading a vol contract or not. So we'd like to be all things vol. That's sort of the whole idea behind the Volatility Views segment, and Don is just an incredible person who won't let things just slide. So, if you send us a comment or a question, I can practically guarantee, which, you can never say that in the CFTC world, but I can practically guarantee that Don will get back to you very quickly.
I've been very impressed. He has outshone me on the forums to a great respect. And also, you mentioned people can provide feedback for the website. The address for that is info@volx.us, I believe.
That's right.
Okay, so if you have any direct comments or questions or suggestions for the VolX website or just in general, shoot it over there and they could address that for you as well. And Bob, I want to thank you for coming on. I'm glad we had you on. We'll have to bring you on again more often to maybe you can fill in the big cheer for Don when he's at its various track and field events.
Okay, great.
He likes to go to.
Thank you, Mark.
Thank you very much. And we'll see you all again next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.